going to move on this morning, continuing our discussion of covering the federal budget. And I'm very happy to introduce a couple of reporters who have a lot of experience covering the economy and the budget. Sudeep Reddy is with the Wall Street Journal. He covers the economy. These are both very experienced prize-winning reporters. And Paul Krawzak with CQ Roll Call. You cover the budget for Congressional Quarterly.
Right.
So these two experts each of them is going to just talk for a few minutes about what they do, and then we're going to take your questions, so be thinking about what you really want to know. Sudeep will start. He's got a couple slides, and once he's finished, then some of the people at the margins can move down to that end of the table, so we'll spread out a little bit.
Yep.
Thank you very much, gentlemen.
Thanks for having me back here. I have done these for a few years, and just show of hands, who's been to one of these before where I've run through this presentation? Just 3 or 4 of you, okay. I've usually found that there are 2 or 3 people in the room who know everything that I'm going to put up here. Some of you know it better than I do. Just bear with me, I'm going to go through this in 5 or 10 minutes. There are a couple people in the room who know nothing of what I'm putting up here, and I'm happy to field questions to help you after we go through this. Most people probably know bits of what I'm about to talk about, and my goal here is to just help with the framework. I know Joe actually ran through some of these in the prior session, so I'm not going to dwell on any of these. But one thing I discovered when I started covering economics 6 or 7 years ago is that a lot of people talk about these terms, and the way they're thrown around, they can get a little bit confusing. They're actually fairly simple. It's a fairly straightforward set of data that if you understand it, I think everything else in the debate about the budget and about the economy on Capitol Hill will be a lot easier. There are a lot of people who try to throw terms around and confuse you, and one of my goals is to help get you past that state of confusion so you can fight back against the lawmaker who's trying to confuse you. So this is 30 seconds on how we think about the economy. You all know the general idea of gross domestic product. That's the figures, those are the highest level figures to measure the US economy. There's a simple definition of GDP that if you've taken Econ 101, you would have come across this. The way we measure GDP, consumer spending plus business investment, which can be how much companies are spending on equipment and software, how much they're spending on new plants and facilities, plus government spending, that's federal, state, local government spending, and net exports. If you add all of those up, that is how you end up with GDP. Consumer spending is about 2/3. In the way we measure it, it's actually a figure called personal consumption expenditures that the BEA tracks. That includes a lot of things that aren't traditional consumer spending. It includes healthcare in PCE, but that's where you get that idea that 2/3 of the U.S. economy is driven by consumers and consumer spending. All these figures add up to $16.9 trillion. There are a lot of different measurements of GDP. You will find some that are closer to 15.8. It depends on how you're doing inflation adjustments. This is the latest raw figure for GDP. And the economy is growing right now. The latest third quarter measurement was that the economy grew at a 4.1% annual pace. We're really growing around 2 to 3% a year. We've been around 2% since the recovery started in the middle of 2009. And the long run trend growth, when you factor in all the boom years of the 90s with the bust years that followed and the deep recession, we're running the longer run trend rate of growth is around 2 to 2.5%. These are all figures that matter a lot in the budget discussion, which is why I'm running through them now. There are a lot of factors that can affect trend growth. One of the reasons you hear a lot of discussion about there are cyclical factors in the economy and structural factors in the economy. The cyclical ones are some of the easier pieces to understand, how people are spending, what's happening with government spending overall, how much is the government putting out, how much is fiscal drag, and then there are the structural factors. You hear a lot about structural factors when you talk about foreign economies, because foreign economies, especially emerging markets, tend to need a lot more work on their structural issues. That means fixing things like the basic rule of law. That's a big focus in African and Asian economies that don't actually have basic rule of law. That's a structural factor. Making sure that there's infrastructure in place in a very basic way, that's a structural factor. When we talk about structural factors in the United States, immigration is a structural factor because it deals with labor flow. And education is probably one of the most important structural factors. All of these things can, if you were to improve them, raise the trend growth that you need. And once you're looking at figures 2 to 2.5% here, if you could bring GDP growth up to 3.5%, you would basically solve all of our problems in the economy. Now, figuring out how to get GDP growth up to 3.5%, obviously everyone wants more growth. It's like cookies and cake. Like everyone likes it, but how to get more growth is what everyone is debating in Washington right now. You've seen the figures for where U.S. total, where this is the GDP figure, and you can see how far we've come. This is obviously not inflation adjusted. I include this here just as reference later because you have to keep this kind of a chart in mind when you're involved in some of the nutty debates we've had over the last 2 years about what we're going to cut and why we're cutting it. We've basically been dealing with that bottom third of the pie here in debating spending cuts, and it never ceases to amaze me how much lawmakers are able to get by with a discussion about that bottom piece without discussing the third rail issues at the top, the cutting Medicare, addressing Social Security, dealing with some of these big pieces like the military in a longer run sustainable way. So the deficit, and the debt. There are always a couple people who can use a little refresher on the deficit and the debt. The debt is accumulated deficits. The deficit is the annual shortfall in the budget. If you add all those up over time, you get the total debt. And the deficit peaked at about 10% of GDP during the financial crisis. That was when tax revenue plunged, economic growth plunged. Obviously, the deficit as a result went up. 10% is too high. The goal for a sustainable deficit should be basically in line with GDP growth. You do not need, for the long run, you don't need to cut spending all the way down to the point where you're equal to tax revenue. You basically need the debt growing at the same pace the economy is growing. And if you can maintain that, you'll be in a relatively good position. We have been, yes.
I'm sorry, can I just clarify what you just said? So in the 4 years or whatever it was that we had the balanced budget,
Yes.
that was not optimal? That having some amount of deficit would be better?
You don't need that. That is certainly optimal when you have very high debts and you want to reduce them. So the surplus years, which I'll show you in the charts in a second, the surplus years would be great now if you could get to that point, because you will get the debt to GDP ratio down to a more sustainable level. Back then, it really wasn't that necessary because you actually had the economy growing, and if you have the economy growing and growing at a fairly healthy pace, then modest deficits, if you're using them for a useful purpose, can be actually a good thing. If you're going to use the deficits to invest in infrastructure, if you're going to use them on education, if you're going to use them on things that matter.
But not paying down the debt?
Paying down the debt now would be a useful purpose because we're actually getting pretty high. This next figure here shows when you get to debt levels that are this high, we're at by the gross debt levels, and there are these two figures that are really important distinctions that you need to think about. The gross debt, all of those, the figure that you see on the big debt clock, that if you were to actually do a proper measurement now, it would be around $17.3 trillion. It's actually not adding up to that at this point because the debt limit was suspended until early February because of the deal to end the government shutdown and raise the debt ceiling. So that's the issue that's going to have to be debated. But once you hit that point, you'll actually, the debt limit will go up and it'll show up around 17.3 trillion. You can check this to the penny every day at the one of the Treasury websites. I included the link here. Debt held by the public. This is the distinction which I think you've gone through in the prior presentation. It matters a lot because money the government owes to itself isn't quite as important as money the government owes to all of us and to other people, investors in the U.S. and around the world. And that's that figure that gets to 73% of GDP. This is where you're gonna see some important debate in the next couple of years about what is a sustainable level. 70% of GDP, a lot of people would see that as a relatively decent debt to GDP ratio, something that is manageable. There's a case to be made that it's manageable if you were to keep it at 70 to 80% and have proper growth going forward, and you actually grow out of something like this. The problem with the Congressional Budget Office, whether it's Democrat or Republican leading it, they make an important point here that if you decide that a 70% debt to GDP ratio is okay, then what happens in the next crisis when you end up going up to 90%? What happens if you have a national emergency and you actually need to borrow? That's the reason you want that kind of cushion. That's why you'd want to pay down the debt eventually, so you can to reduce the debt a bit, so you can have more cushion so that you're not getting into dangerous levels. As you all know, there's no red line in what is a dangerous level. Eventually, you can create enough debt that bond markets revolt. They don't believe that the government is going to pay back that debt and start demanding a higher interest rate. And when you demand a higher interest rate, that means you crowd out. The government spends more on interest payments, and you crowd out other spending, and you end up in a very ugly situation for the economy and for the government balance sheet. What that line is, Ken Rogoff and Carmen Reinhart did a study that some of you may know about. It's come under quite a bit of controversy over the last year, and they looked at debt levels historically across governments and decided that 90% debt to GDP is a marker that will lead to slower growth eventually. That is across all economies. The U.S., and they're using the gross debt figure. So the U.S. is obviously above that, but that study has come under quite a bit of scrutiny, and we won't go into all the reasons for that. But if you want to look past that, you can say, well, the U.S. is different, and there's a reason the U.S. is different. It is the reserve currency of the world. Bond markets don't revolt against the reserve currency. They rely on it, and you're not going to see this night and day switch between what's a safe level of debt and what's a dangerous level of debt. It's something that will happen over time, and if you were to try to draw out what happens eventually, it would probably require some kind of national emergency for that to become an issue, for people to actually pay attention to debt levels being too high and questioning whether the government can actually pay off those debt levels over time. Yep.
So what's the other $5 trillion difference between?
That is a lot of it is money held in the Social Security trust fund, money owed to the government. There are trust funds within the government that the reason you don't worry about that as much is eventually, if the U.S. is going to keep its commitments to Social Security recipients, then it's either going to raise taxes or it's going to, or if it doesn't keep the commitments, it'll cut back on those benefits. So this is that chart. You can see what happened in the financial crisis. The gray bars are recession periods, and it's fairly straightforward what happens in a recession versus a recovery. In a recession, you have economic growth slowing, tax revenue falling, and so the deficit will rise, and the debt will rise, and eventually, if you see in the 1990s years, that was a period of the strongest economic growth we've seen in the post-World War II era. We actually saw that come down, and that is not going to be repeated anytime soon. Yep.
If you look at that, such a steep, from 30-something to 70-something,
Uh-huh.
how much of that is falling tax revenue versus smaller GDP, so the percent would be higher? I mean,
It's a great question. A lot of that, the bulk of that, is due to tax revenue that's not high enough to meet our spending commitments. And if you look at what happened throughout the 2000s, you could see that creeping up, even though we were in a recovery. There are factors of war in there, but the biggest thing is if you look at very easily, look at 2007 to 2009, when the economy crashes, when you have slow economic growth, that's the result of it. So there's an important debate about whether taxes should have been cut to the degree they were, but the deficit did get down to something like $200 billion in the late Bush years. So in the short run, it wasn't disastrous, though there were some longer-term issues that should have been addressed, because you should have, if you really were going to create new spending programs and start wars, then it's probably not a great idea to be cutting taxes at the same time, and the consequences of that are very clear now. And then you can see here that spike that we were just talking about earlier in the late 1990s, when you actually had, for 4 years, the deficit turning into a surplus. All of these charts you can pull up very easily. Fred, the St. Louis Fed, puts out, updates this data usually within minutes of its release, and it's an amazing site for you to be able to not only create charts like this to see what's happening, but also to pull the raw data and download it to create charts. We use it all the time to create charts at the Journal. Percent of GDP, we're right around, we've gone from that 10%, we're right around 6%. To GDP, so you can run through this later. The one exception I point out here for debt to GDP ratios, Japan is the greatest outlier. If you looked at Japan's debt to GDP ratio, it is 200% right now and climbing. It's well over 200%. That's a country that you would have bet in the last 15 years would have a debt crisis, but the yen is one of the reserve currencies of the world, and they have a lot of internal savings. So for whatever reason, they have not had a crisis. There are warnings every few months from the IMF about Japan and its debt levels. Someday we will come to the point where that is not sustainable, where investors will finally give up on Japan if it doesn't get out of its slump that it's in. But that day has not come, and probably isn't going to come in the next year either. Probably don't need to run through this. This is just a simple chart that we've run online many times of what happens. I pull this up. There's a fantasy out there that cutting spending will lead to stronger growth. And that may be true in the long run if you were to cut spending in the right way that increases confidence among investors and among businesses. Then maybe they will go out and spend more and invest more, and then you'll end up with stronger growth. But in the short run, it is indisputable that cutting spending slows the growth rate, and do not let anyone tell you otherwise, because there's just no evidence that suddenly cutting spending, the austerity program that we've seen in Europe, has devastated a lot of economies there, and cutting spending will slow growth, at least in the short run. Whether you want to make the argument that it will increase confidence and that you need to deal with it in the long run is a worthwhile debate to have, but for people to say that immediate budget cuts would be good for the economy is kind of nutty. We will talk about some of these in a minute. We've already run through a few of these, but I point to the third one here. When you are starting to see the budget projections from Democrats and Republicans in the next few months, watch for what they do about growth assumptions, because as we were saying earlier, if you can get growth from 2% to 3%, you solve a lot of your problems. If you can somehow magically pencil in growth at 3.5% or 4%, then all of your special programs and your pet ideas suddenly work when you pencil in higher growth. But you have to actually assume that you're going to get the higher growth, and that hasn't happened. Okay.
All right, great. So I think I'd like to start out with just sort of looking at the budget timetable this year, and I know that Joe covered some of this, but And Joe talked about the January 15 deadline for the fiscal 14 omnibus. He talked about that. Wasn't sure whether they're going to meet that deadline or not. The next thing that comes up after that is, and he mentioned this also, is the debt limit suspension expires on February 7. So that's something they're going to start working on right away. As he mentioned, it's unclear what House Republicans will ask for on that. Even though the suspension ends February 7, it actually, extraordinary measures will be used, and that will actually that will extend the date of default probably sometime into March. The President's budget is due February 3, first Monday in February. It's running about a month late right now, so I would not expect it until sometime in March. Last year it wasn't released until I think early April. The House and Senate budget resolutions, they aren't really necessary this year because the budget deal has the discretionary top line, 302A, for fiscal 2015. But Paul Ryan is going to mark up a budget resolution anyway. It'll probably be very similar to the one that he's done the past couple years. It'll be interesting, though, to see whether there are any changes in it. It's unclear whether Patty Murray will do a budget resolution. What is more clear is that even if she does one, it probably will not get voted on in the Senate. It's unlikely that Harry Reid would allow a vote on a budget resolution. And various arguments will be made as to why they don't need to do one, but that would be my expectation. Is it a little quiet? Is it the right here? Is it this? Does this work? Okay. All right. So that's the timeline. A few observations and tips. And I think Joe may have gotten into this as well. The deficit is falling right now. It'll fall through 2016 or 2017, and then it'll start rising again, and it'll continue to rise. So the falling deficit is a temporary phenomenon. I would not expect there to be a lot new in either the President's budget or the House budget resolution. Of course, it'll be a story, whatever is new, but I think everything is going to be sort of, all these budget proposals are going to, I would look at them in light of the upcoming midterm elections. There's going to be a lot of sort of political positioning of these budget proposals with the election in mind. In terms of, getting ready to cover write about the release of the President's budget or even the House budget resolution, I found it's always useful to make contact with sources ahead of time, congressional staff, associations, organizations, budget analysts, and find out what they're expecting, what they'd like to see in the President's budget, for example. When you're writing about the budget, use like numbers. For example, there's budget authority and there are outlays. Does everyone understand the difference between?
You ran through the.
Yeah, okay. So, and you'll find budget authority and you'll find outlays. You'll find those in the President's budget and you'll find them in the budget resolutions as well. And budget authority is how much an agency is allowed to spend by Congress. That's budget authority. The outlay is how much it actually spends. So, for example, take the Department of Defense. Say an appropriations bill is passed giving the Department of Defense budget authority to spend this much next year. That's the budget authority, but it's probably not going to spend all of that next year. Some of that it will spend in the next year, or maybe the year after that. So budget authority is how much it can spend. Outlays is how much it actually spends. So next year, for example, the Defense Department might have the budget authority to spend this much, but it will actually spend less than that. What actually is spent is the outlay. The outlays are what actually is spent in a year. So there's this lag. So you should be cognizant of whether you're talking about budget authority or outlays, and you should not mix those two numbers together.
Hey, Paul.
Yeah.
So if the outlays come under budget authority, didn't we hear a story like a year ago or so that sometimes the agencies, rather than that's surplus money, that earmark or whatever, that phantom money could carry over year to year to year until like 6 years later, you could still use the money from 6 years prior because you hadn't spent it at the time, or am I confused?
Right. So if an appropriations bill is passed, which provides a certain amount of budget authority, you don't have to spend all of that next year. There are some programs that stretch over several years. So you would probably spend most of the money next year, but some of it you would spend the next year, and maybe some of it the next year as well.
So they're not giving money back. Nobody's giving money back if they have outlays that are below budget authority.
Well, that would depend on the program, but in general, budget authority can be spent in succeeding years, and it usually is. The other way to think about it is take fiscal year 15, for example, or let's go back a couple years when we know how much was spent, and we can look at the total outlays spent in a given year, and that spending, some of it will have been budget authority for that year, and some of it will have been budget authority from a previous year that was spent that year. So the outlay figure is, simply put, outlays is how much you actually spend in a given year. Budget authority is how much you are allowed by Congress to spend. And you don't spend it all that year
So
in most
technically,
cases.
you could have higher outlays than your budget authority for that year because you were using some money from prior years, so you didn't go over.
Right, and you usually do, although if spending is being cut, you may end up with a situation where you have higher budget authority than actual outlays.
Thank you.
So it depends. Sometimes it's higher, sometimes it's lower.
So, Paul, does this, just to clarify, does this difference have to do with projects that are budgeted over multiple years? So you may get authority in 1 year to build a ship, and then your outlays come over the next several years as the ship is actually constructed?
Right, that's a good example. Right.
So it's not like you just have a certain amount of budget authority, but, oh, we didn't need it this year, so we're keeping it in our back pocket for next year. It's actually budgeted for things that just haven't happened yet.
Right, and also, you can only be so precise in projecting how much you're going to have to spend for a program in any given year.
Maybe another way of looking at it, like transportation reauthorization bill every 5 years, 6 years, is authority to spend a bunch of money over that years, but each year they have to be appropriated, right?
Right. But you could do an appropriation for fiscal year 15 for highway programs, and that appropriation will be in the form of budget authority. This is how much you can spend next year on highway programs. But you may not spend it all next year. You may spend some of it the following year. Any other questions on that? Okay, so that's one place where you want to use like numbers. Another place is the Congressional Budget Office versus the Office of Management and Budget. If you look at CBO's deficit projection for this year, it's $560 billion. If you look at OMB's deficit projection for this year, it's $750 billion. CBO and OMB have different sets of assumptions. And so their projections of revenue, spending, and deficits are different. So do not assume that those numbers are the same. They're different. What
So
we
OMB is part of an arm of the White House.
Right. It's the White House Office of Management and Budget. Right. And they have their own assumptions for projecting. And the Congressional Budget Office works for Congress. It's the scorekeeper for Congress. It has its own baseline, which is its projection of what spending revenues will be under as if current law were continued.
Is one better than the other?
You know, there's debate on that as to which is more accurate. The OMB projections are generally based on the president's proposals, whereas CBO projections are based on what is current law and, you know, how much our revenue is going to grow based on our economic projections. They have their own sets of economic projections as well. And what we do at CQ, for example, is if we're writing a story about a Treasury report, you know, a monthly Treasury report, we use, you know, and the Treasury says, you know, this is what the deficit actually was, you know, this month. We might go back and say, well, this is what OMB projected it would be. So we use OMB figures when we write about a Treasury report. When we write about a congressional proposal or a bill, we use CBO because CBO is the organization that does the actual projections and cost estimates for Congress. I'm sorry, did you have a question?
You answered it. It was in what kind of reporting would you refer to each?
Okay.
So.
Okay. All right. Another area where you want to use like numbers is take the Ryan budget and take the Murray budget from last year. If you go back and look at those budget resolutions, you'll see that, you know, Ryan projected, you know, we will cut the deficit by this much, and we will cut spending by this much. And Murray's budget projected we will cut the deficit by this much, and we will cut spending by this much. And what makes it a little complicated is they each constructed their own baselines. So so the CBO has its baseline, which, and is there any question about what the CBO baseline is?
Yeah,
What
can
that's?
you tell
Yeah.
us?
So what CBO does is it does a 10-year baseline, and they say it's not really a projection or a prediction, but it really is kind of a projection. And they project what spending is going to be over 10 years, what revenues are going to be, what the deficit's going to be each year, and what the debt's going to be each year. And they base this on current law. They say, you know, if current law remained exactly the way it is for the next 10 years, this is what we would expect spending, revenues, deficit, and debt to be every year. Of course, current law isn't going to remain. I mean, laws are being passed every day. So, but the way CBO explains it, it's basically a benchmark. The baseline is a benchmark so that when you come up with a bill, you can compare that bill to the baseline and figure out how much the bill will cut spending or raise spending or whatever. So the CBO baseline is really the gold standard. But when Ryan put together his budget, he put together his own baseline, which is the way he thinks revenues and spending are going to go. And it's a little different than the CBO baseline. And when Murray put together her budget, she created her own baseline, which is what she thinks is going to happen to spending and revenues. And that, too, is a little different than the CBO baseline. So if you just sort of look at the claims of the Ryan budget and the claims of the Murray budget and compare them, it's not really, it's not comparing apples to apples, because Ryan is basing his deficit reduction on his own expectation of what's going to happen, and same thing with Murray. So what we do at CQ is we take the Ryan budget and Murray budget and we compare them both to the CBO baseline. So we then are comparing apples to apples. So, for example, we take the amount of spending that Ryan is proposing, and we compare that to the CBO baseline spending. Same thing with the Murray budget. Is that understandable at all, or is that confusing?
And then if they deviate really far from the CBO budget, that can maybe be a sign that some of the proposals are unrealistic, or, that might be worth reporting on.
Right. I mean, so for example, you look at the Ryan budget, and the last Ryan budget was designed to balance the budget in 10 years. Is that really going to happen? Is Congress really going to pass a budget that balances it in 10 years? Obviously the answer is no. Those two budgets were so far apart that they were unable to, get any agreement on the 10-year plan. Which kind of brings us to, what a budget resolution is. And Joe may have covered this, but a budget resolution is really, it's a blueprint for the next 10 years. It's what a party or the author of the budget would like to see in terms of spending, revenue, spending cuts, tax increases, whatever. So it's sort of a 10-year plan. It's completely non-binding, but it's sort of a vision. It's really sort of a fiscal vision. The most important part of it is the top-line discretionary number, the 302A, and that's almost the only important part of it. The only important thing a budget resolution really does, the only substantial thing it does is it gives the appropriators a maximum of discretionary spending that they are allowed.
Just to follow up on the baseline issue, if you have Murray and Ryan proposing budgets, obviously they're going to be different, because one's going to want to raise taxes more, and maybe another one's going to want to lower spending more.
Mm-hmm.
But so clearly those are changes in the law which would make it different than the baseline, but do they accept, common assumptions about economic growth, for instance? Do they play with how fast they think healthcare inflation will be? These other sort of underlying assumptions that change the revenue, change the spending. Or in other words, are they, on one level, you expect them to play with different numbers because they're making different proposals, but do they agree on the basic?
They do agree. Yeah, that's a good point. They're largely based on the CBO baseline. Both budgets are largely based on the CBO baseline. But Ryan, for example, will say, these policies, these laws, which the CBO baseline assumes will continue, we don't think they're really going to continue. We think that Congress is not going to do this. And the same thing with Murray. So really when they create their own baselines, they're really just tweaking the CBO baseline. That's a good point.
I have a question about reading the CBO cost estimates. Should you always use that 10-year figure? The issue came up just today, for example, when you were looking at the CBO estimate for the unemployment 3-month extension. And I think CBO said over 10 years it would cost $6.4 billion, but the current year would be $6.4 billion. So it was a slight difference, but a difference. And I've seen it reported 2 different ways how much the 3-month extension costs. So should you defer to one versus the other?
That's a good point. You might have a situation where, and I think this is sort of the situation there, where what's really happening in terms of the increased cost, it's really happening primarily like over 3 months. And if you look at a 10-year estimate of that, it's almost the same figure. But a 10-year estimate is, that's not very meaningful, because it's really something that starts now and ends 3 months later. So, why even use a 10-year estimate for that?
So as a matter of course, you should use the current year estimate versus the 10-year?
I think it depends on what the issue is. I mean, if it's, like, for example, this budget deal that they got in December, it cuts mandatory spending over 10 years by $85 billion. And that happens over a whole 10-year period. So in that case, you'd want to say, it cuts it over 10 years. If it were something where, like, it only cuts mandatory spending over the next 2 years, I mean, you should note that. You should say, the savings over 10 years is this, but really all the action happens in the first 2 years.
I actually had a question for Sudeep, if I could go back to something you had talked about saying definitively that cutting spending hurts growth in the short run. Obviously, you run into a lot of folks who present a different point of view on
Right.
that and will trot out their own experts and
Uh-huh.
studies. So how do you handle that in reporting when someone makes the argument that we need to cut spending right now, and you're saying definitively that's not going to help growth? How do you deal with that story?
First, you look for somebody to provide evidence of a case where cutting spending immediately actually grew an economy immediately. And there are very few cases where you would see that. There are perhaps a few cases where a totally wrecked economy somewhere were collapsing at a 10 or 20% annual rate because of its out of control spending, and maybe it was collapsing at a 5 to 10% annual rate because you were cutting spending. And so if you were to actually provide some immediate budget discipline to a warlord economy, then that might actually make a difference. I think you have to probe a little bit when you're talking to the lawmakers of why they're saying you need to cut the spending immediately. One is most of them don't believe that if you actually enact longer run spending cuts, they will ever be executed. So you can put things into a budget and they become fantasy items that will never actually happen. And so that's one reason why there's so much of a strong push by the GOP now to do immediate spending cuts, is because you might actually get them in place. The cleanest way to look at this, Ben Bernanke has put this in his speeches for 2 years and in all of his testimony to Congress, that the smart way to deal with this is to pass the spending cuts now that take effect a few years from now, because that provides the kind of certainty that everyone talks about that you want from a government. You want certainty of what the spending will be like a few years from now, what programs are going to be cut. You can actually plan for that instead of going through the ridiculous charade of the sequester of doing these short-term deals where you don't even know whether you're going to have a funded agency a few months from now. And then if you bake those in, then you can actually, that's the Bernanke mix is short-term support for the economy to deal with the weakness we have now with longer-run spending cuts. Achieving longer-run spending cuts has proven politically impossible. So that's why the default case is to then go to short-term cuts. But the only basis for the argument that cutting spending, that slashing spending now will improve the economy is the confidence argument that by slashing it enough, you're going to suddenly create all this confidence among businesses and investors that they'll then go out and spend. And there's not really meaningful evidence for that. There is some evidence for the 1990s cuts under Clinton, when the budget started to get closer to balanced. Part of the benefit of that is interest rates came down, and so bond market investors could see that the government was going to be more reliable in its spending. And so when interest rates come down, then you actually see a boost in the economy. Interest rates have been at historic lows for years, and so that's not really a workable argument this time.
So when someone says that in your story, you just say, most economists disagree.
Yeah. Oh,
or
yeah.
something like that.
You specifically state that. I state it as fact that cutting spending now would slow the economy in the short run. Some proponents of the cuts say it would produce enough confidence to offset that, but even then I feel kind of icky writing that because there's no evidence for it. But a lot of people, look, there's enough uncertainty in economics that you can, if somebody wants to provide an argument about the best way to deal with a troubled economy, then you have to give their idea some weight. But that's the idea, is that it will suddenly boost confidence. Yeah.
This is maybe a little bit niche, but I wonder if it's come up in your reporting on the budget, the oil and gas production and how much that's increased. And Obama talking about cutting subsidies for those industries. Have you looked at, does that come up in your reporting, how much you can get out of that? And is it getting any traction politically?
For me, not really, because I'm more covering the big picture of the budget. We have other reporters who focus on individual areas, and I mean, they've written about that a little bit.
You will get some benefit, but I see a lot of the debate about that issue to be more around the conceptual idea of whether you're actually, if you encourage more energy production, then it makes the market better supplied, and you can deal with the market issues. You probably have more of an economic, broader economic benefit from producing each additional barrel of oil by the effect on gasoline prices and consumer spending, if you can actually ramp it up significantly, than you do from any government revenue that would come in from that. But that's an important, all of these discussions about the budget come down to principle in many ways as well. Is it worthwhile to be spending the money that we do on programs that might seem nutty to most Americans? And that's unfortunately, that doesn't get placed in the proper context, because we should be making smart decisions about each of these programs and they should be addressed, but dealing with those does not deal with the larger economic problems in the budget that should be addressed in some way. And you have to deal with the big three: the healthcare issue, other entitlements like Social Security and defense, before you're really going to get anywhere.
Is there a consensus about whether a 3.5% GDP growth is attainable?
There is no consensus. There's little consensus on anything in economics, unfortunately, which is why it can be twisted so easily by most people. There is consensus that 3% growth is attainable. How you get above 3% growth is the big mystery. Some people say you need to actually execute on all these other structural issues. You need immigration reform so that you're bringing in particularly higher skilled workers, but also that you're providing you're filling all the needs for lower skilled workers as well. That's the great benefit of the United States, is that we can draw in people at both ends of the labor spectrum. And then dealing with all the other issues like education and infrastructure and the things that pay off 10 years down the road. Those can matter, but with 2-year terms in Congress, it's hard to do anything that will pay off 10 years down the road.
So did you say that a 3.5% growth rate is robust enough to sort of resolve the other?
3.5% growth would go a very long way to resolving most of our problems. A percentage point of growth, going from 2.5% to 3.5% in the long run, if you could actually sustain that kind of growth, then a lot of our problems go away. There's a book out there called The 4% Solution by some former Bush advisors. If you get 4% growth, then all our problems are solved. Well, the best part of the book is the title, because once you get into it, how you actually get to 4% growth is the magic potion in all of this.
Two quick questions. One about the growth. Not reporting pretty much on both sides of the spectrum. They said, well, we can't grow ourselves out of this problem because this issue with healthcare, especially in retiring and demographics, is kind of swamped. Just curious, is that fundamentally challengeable, or is it pretty safe to say? And then the second thing is, everybody I've talked to said the same thing that you said, Bernanke said, which is the smart thing would be to pass a law now that phases in drastic cuts. It seems like there's a problem in that we have, there's no way for Congress to restrain itself in the future. So no matter how much you agree today, you'll have a new Congress in 5 years, and they may just change their mind. So, a new president or whatever. I'm just wondering if you've heard of any political solutions that might address that inherent lack of stability.
Congress has been created in coming up with triggers and lots of penalties. That's how the sequester came about. Not exactly a good form of a result from a trigger, but there are ways to do it where you can force the changes to stay in place. You could pass, theoretically, you could pass a law that requires, that enacts them and requires some number of people to pass it, to override it. You can require, by structuring what the other cuts are. So if you were to undo this package, then the only way to undo it, you will immediately trigger something else. So obviously you can pass any kind of law to change anything, which is why there's been so much so much attention on short-term spending cuts, because nobody believes long-term cuts are actually attainable. But if you actually had the political will to do something like that, to have members of Congress vote to do longer run cuts, then there are ways to make it more durable, but there's no way to bulletproof something like that. On the first issue, you are completely right that healthcare is the big problem in all of these charts. If you look at any CBO analysis of this, CBO does these projections out to 2040, and if you look at any of them, I don't know if I've got one here, but you can see them in any of the documents you should be looking at for this. This is the one that came out in September, the 2013 long-term budget outlook. It's on the homepage of cbo.gov. It's got all the charts you could possibly want. If you look at any of these, healthcare is obviously the issue. The big question, the conundrum right now is, why has healthcare spending slowed over the last few years? Has it slowed simply because of the recession? And if it slowed because of the recession, then it's simply a cyclical factor, and the slowest spending growth in 50 years continuing would be highly unlikely. As the economy recovers, people go out and spend more on healthcare services. If there is some durable underlying reason of why healthcare spending has slowed, then you can see that curve that's based on historicals and projections. You'll see that curve bend. It won't bend entirely, but it will bend in a very meaningful manner. And there are, obviously, as you know, hundreds of provisions in Obamacare that are designed, if the thing actually gets off the ground and starts working, that are designed to slow spending growth, and that could, in theory, maintain the slower growth in healthcare spending. That gets to a very important point about these debates. Paul said that these 10-year horizons are benchmarks. You use them for a lot of reasons, but a 10-year horizon doesn't do you a lot of good when you're dealing with questions that last 40 or 50 years. There's a healthy debate about whether these projections of 10 years are too short because of the long-term entitlement issues, and some people think they're too long because there's no real way anyone can know what's going to happen with the economy 8 or 10 years from now. To imagine in 2004 that we would go through the 6-year, 10-year surge in housing prices all the way up to bubble levels, have a global financial crisis, and then come out of it to this point. It's just like nobody can model something like that. And to imagine in 1993 that you would have not only the balanced budget amendments and the surplus, plus the entire internet boom, the technology stock bubble, 9/11, and a couple of wars. It's ridiculous to think that anyone can actually make a projection that matters at that point. But you have to use something, and there's a reason we don't have 30-year projections, because 10-year projections are hard enough and require so many assumptions that they're barely plausible in the first place.
Just a quick note on that, concerning sort of the Bernanke position, that you can, don't cut spending now. because you don't want to hurt the economy, but, you know, in a few years, cut it then. I mean, practically speaking, it's hard to do that. I mean, it's hard to, you know, say, okay, we're not going to do anything now about spending, but in a couple of years we're going to make these cuts. Well, what cuts are you talking about? I mean, I think, you know, Bernanke has not been specific, obviously, but he's certainly pointed to the growth of federal, you know, healthcare spending, and the need to restrain that, and the need to restrain the growing debt, which is growing faster than the economy. But I mean, but there's no agreement between Republicans and Democrats on how you cut federal spending, on how you cut entitlements. So, you know, so it's easy to say let's wait for a few years and cut, but I mean, nobody's agreeing right now on what you would cut if you waited a few years.
And the Greenspan Commission did this with Social Security decades ago, and it worked. Do you have any sense of why it worked, other than having the political will to do something then that would take effect decades from now?
They were able to reach an agreement, and I mean, I think at some point they will reach an agreement on Social Security again, but I don't see it happening anytime soon.
One of you guys were talking about the extraordinary measures, the tricks, whatever you want to call them, that once you get to February 7th and you lose your borrowing authority, et cetera. What does it cost to do extraordinary measures? Like, what is the actual cost to taxpayers of employing 2 or 3 months of gimmicks, of shuffling the books, of not doing this, of doing this? What is there a cost?
I don't think the extraordinary measures themselves are a cost. They're a gimmick that.
Like staff, you know what I mean? Like, if you have to you sacrifice interest gains on money that you have to take to pay for something that you would have had in an account, or no?
Not that I
don't think so. I mean, you have to make it up. I mean, basically what you're doing is you are delaying actions which would increase the debt. For example, you're delaying, you know, reinvestment of federal retirement accounts, and you have to make that up once the debt limit is raised again. And what you have to make up is factored into the debt limit increase. But I don't think there's really I don't think there's a cost to that.
You're just
although I
moving
could be
around
wrong.
pieces in special funds. These were ideas that were engineered by Robert Rubin in the 90s, and they became. That's why they're not really that extraordinary anymore, is because you know it's going to happen. You know the money's going to move around, and this time the expectation is that the extraordinary measures will last a shorter period into late February or early March because of the timing of this coming in tax season. So it's just a shorter runway, but everyone expects the extraordinary measures to be used now, and that's actually what provides a little bit of the cushion to prevent a default at the final moment. At some point in our lifetime, we're probably going to have this fight get even worse than it has been, where you push it well beyond the X date that people talk about. And instead of actually having a default, because you have the extraordinary measures, you can avoid an actual if you're the Treasury Secretary, you can avoid an actual default, but you will have such a vicious revolt in markets by the time you hit that date that the actual default won't matter as much, because you will do the damage anyway. And by having a market meltdown of some kind, that there is a cost to that, and GAO has actually estimated the cost of debt limit battles because of what it does to short-term interest rates. And even in the last one that got settled fairly cleanly, there was an obvious increase in short-term funding costs that the government ended up paying, and that you could see in investors. They were selling short-term debt because they didn't want to hold on to it, so it pushed interest rates up on the short-term end of the curve, and that is a cost to the government.
What is the cost? Like, every time you have
It's a couple $1 billion.
Paul,
Right,
what?
right.
I'm sorry.
Just, do you have any suggestions for writing for a general audience, ways that we can, make these fights relevant to them? Budget fight, the upcoming debt limit discussion. If I'm writing for general public, how can we story ideas for doing that?
a couple quick thoughts. I mean, I think one is so you look at your audience and what issues is the audience in your district or state or whatever interested in. And then, look to the president's budget for how it deals with those particular issues. I mean, maybe it's, maybe it's agriculture, maybe it's something like that. And I mean, what I like to do is I will contact the association or the organization or experts on this particular area before the budget comes out and find out, what do they expect, what would they like to see, et cetera. So, I mean, that's the one obvious thing to do. And try to write it in, language which is understandable, define your terms. The other thing that I think isn't done as much is sort of look at the budget, apart from how it affects the district or the state, how will this affect the country? I mean, if this budget were implemented, what does it do about the rising debt, either through spending cuts or tax increases or whatever? Because, for example, I mean, CBO says that the growth of the debt is unsustainable, given current trends. So what does that mean? I mean, that means at some point the government starts running out of money. And what does that mean for Medicare or Social Security or defense or other programs? So I think it's important to look at sort of the effect on the country of policies as well as just the effect on your local area. I'm not sure if that answers your question.
One story I don't see enough of, if you look at polling on the deficit and the debt, there are plenty of people who say they are concerned about it. There's always some subset of people who are concerned who don't actually know the difference between deficit and debt, but you have to get past that. So find the people who are concerned about it. There are businesses who claim that it's holding back their investment. They say that all of the discord is holding them back, and it's probably among small businesses in particular. And find the people who actually say that they're worried about this and drill down and figure out what they're actually worried about. There's a wealth of academic research on future taxes and what is the economic effect of concern about the tax burden. So if you don't believe that the current government budget situation is sustainable, then under the academic literature, you will hold back some of your savings because you expect to be taxed higher in the future. And as a result of that, you will spend less now and you will make adjustments in your lifestyle as a result of it. I'm skeptical people actually make those kinds of decisions that far out, but that is the basis of that kind of a theory, that you are going to adjust your behavior now because you don't believe something is going to last into the future. I see a more plausible case among businesses when we've done these stories around the shutdown and around the debt ceiling. Businesses say that they're worried about what's going to happen. What they're probably more worried about is that there's going to be some kind of market discord and the whole system's going to come crashing down around them because the memories of 2008 are so raw that they're holding back. But there's something happening in some of these periods. And you can go into certain sectors. If you look at the defense sector, you can see in the data periods around a government shutdown, periods around debt ceiling fights tend to have some kind of a pullback in federal defense spending. Sometimes you see the surge going into it as everyone's spending money, and then the drop right afterward. There's a lot of volatility in that. And what does that mean for their hiring? What does it mean for their investment plans when you're seeing budgets moving barely within sometimes a few months, and even in this one, 2 years? How much certainty does that actually provide?
With the debt limit coming up again, can you give us some advice on when we're writing, how to define default, especially at a time when some lawmakers will say that there is no way that we could default on our debt by paying our actual interest?
That's a great question. There are two kinds of default. One is a default on obligations, and the other is a default on debt. People mix these two together. Mostly House Republicans, some Senate Republicans say default on debt is all that you should worry about, that as long as you're making debt payments, then you can cut anything else and avoiding a debt default is what will preserve your AAA credit rating, and or what's left of the AAA credit rating, and prevent the global devastation in financial markets. It is true that avoiding a debt default will prevent investors around the world from panicking, because if the U.S. government is making the promise that it's going to keep paying its obligations on debt, then there's no reason for everyone around the world to panic. And the reason this matters, the U.S. Treasury debt is the foundation for most financial markets around the world. It's the super safe security. Everything is priced against treasuries, and so if you start screwing with that, then you're really messing with the fundamental underpinning of just about every financial market in the world. The other is the default on obligations. So not paying a bill, so the government deciding not to pay a bill is a not a good thing in the first place. And if this is obviously untested, but if the government were to hit that date and start prioritizing payments and pays debt but doesn't pay Social Security recipients, or even doesn't pay the contractor for a cleaning company in a government agency, that is still default. This is where it's disputed. The Treasury Department says that's default by any other name. There are probably rating firms that will decide that is still default, that the government has defaulted. By the time you get to that point, though, you're in such crazy land in markets. When you actually get to the point where the Treasury Secretary has to come out and announce what he is prioritizing, they have a plan for this, and when they announce the plan that they're only going to pay debt and they're not going to pay other stuff, then you will have already seen the damage in markets. That's why you don't get to that point, is because as you get closer and closer, you see the wreckage starting to build up, and that's what prompts Congress to stop playing the game. Is that clear?
And just to follow up
Yeah.
on that, so it is true that there are measures that could be taken to just pay the debt to avoid a technical default on our debt.
So
Okay.
there's some debate about whether that is actually allowed legally, and I don't think that would really be challenged. That if the Treasury Secretary decides he's going to pay debt obligations, I think people would generally assume that to be a reasonable course. It's more of a political problem when you get to that point. There are payments on debt is done through a separate system, so there's something called FedWire that allows the government to pay. The other payments, the 100 million other payments that are done, that's more complicated because it's an automated system. It's designed to make payments, not to not make payments. So how you actually stop that and decide to halt the computer system that you're not going to make a certain set of payments is complicated. The easiest way to do that would be to decide you're not going to pay anything on Social Security and Medicare. Those are the two biggest ones. But then you'll be accused of playing politics and choosing the one that gets the most attention.
Thank you.
You know, we've gone from the Recovery Act to an austerity budget. What would be the most meaningful way to show what's happened to federal spending?
Can you repeat the question, please, for people who might not?
Yeah, so what's the most meaningful way to show what's happened to federal spending? And federal spending actually, overall federal spending actually has dropped the past couple of years, which is interesting, and that hardly ever happens. But so what I would do is I'd look at the congressional, the CBO Budget and Economic Outlook, which comes out once a year, and then an update comes out later in the year, and they will show you revenues and spending, and so you can actually look at total spending and what it was in any given year.
But you talked about the baseline, the Murray and Ryan, concocting their own baseline. So what is a meaningful, like the base year to even look at? Pre-2008, do you base it on per capita federal spending, or, to show that really that the government has shrunk?
Well, I mean, I normally just look at total spending as a measure, but you're thinking of a different measure than that.
Right, I guess I was wondering about a way to illustrate just how much the reality has changed in terms of where we were even, say, 5 years ago, you know, that, I mean, what, the reality is that we're spending far less, right, than we had, certainly even before the Recovery Act, right? But how much less? Like, you base that on, you know, given what you would normally have expected in terms of regular, you know, federal spending growth, just based on inflation and population growth versus where we are today, you know, under this Ryan Murray budget. You know, how much belt tightening have we done? Like,
You can find estimates of this mostly through think tanks, and if you email me, I'll point you to some of them that would show what, and you can usually break them down by components. So discretionary spending, what was the path before, what's the path now? You can obviously see that discretionary spending has flattened and started to come down. If you look at the CBO figures, this is their projection from September. You can see what happened. Federal spending as a share of GDP. You should always be using these figures as a share of GDP. That's what matters over the long run. And so federal spending as a share of GDP went up. There's the recovery years, comes down, it flattens out for years. You can pull all of these figures. If you go to the website, Fred, from the St. Louis Fed, you can pull all the raw data for this and actually show. You can chart discretionary spending, you can chart overall spending as a share of GDP, and just show what's happened in the raw numbers of what happened before and what's happened since, to show that spending has actually slowed. And that's worth doing. And then you can pull specific figures, what happened with federal spending in prior recoveries and how much it rose in those recoveries and how much it's flattened out now. You can do that with state and local government spending. They're all available.
Could you get at that also if you went to like the Bureau of Labor Statistics and for each recovery showed the shrinkage of government jobs?
Yes.
Could you see that they shrunk by 10,000 or 100,000, and you know, and how much the government has contracted in the last 5 years on government jobs? Would that be an accurate measure?
That the BLS would be the place to do that, and you can see that federal government jobs are down a bit over the last couple of years now. They've basically flatlined, but you can see what happened with obviously state and local government jobs can be influenced by federal spending, and you have not seen the kind of surge that you would have seen in prior recoveries. There are plenty of, if you email me, I'll point you to some of the really good charts out there of showing what happened with government jobs in prior recoveries versus this one. It made a big difference.
Particularly, Sudeep, since most of your readers are outside of Washington, you cover something that's very kind of both academic in terms of economics, but also Washington, you cover policy. So how do you break free of that sort of insular world to write stories that your estimation make a real difference to readers in Texas or Kentucky or wherever? And I'm just wondering if you could point to a couple examples of where you feel like you really feel good about what you've done in terms of getting away from the insider, what Ryan's proposing versus what Murray is, that kind of thing.
I don't know that when you get to specific budget proposals, there's a great way to do it other than looking at who's affected, where the cuts are, which programs are affected, particularly when they hit different parts of the country. That's a very good way to do that. Because of what I do on economics, it's easy to go and find the businesses that are hit, the questions of uncertainty in the economy, how people might be holding back, what their motivations are. That's where all of this stuff ultimately matters. Otherwise, if there weren't any effect on businesses and consumers and consumer confidence and business confidence, then you'd see a lot more serial brinkmanship. You'd see a lot more of these fights. But once you actually notice the effects, and it's a matter of connecting the polling data, connecting the macro with people on the ground. And for all these kinds of stories, if I don't already have contacts with some of these places, you reach out to the chambers of commerce, you reach out to local business groups if you don't have contacts, and ask them for people they've heard of who have been cutting back. The one of the easiest places to do it is to just find out who's hiring. Those are the people who generally tend not to be concerned about this stuff at that time. Find out the people. You can search. I use Twitter now when I want to find out somebody who just lost a job. People will tweet, "Just lost my job," and you can very easily find people and then trace it back through. Usually they put their name on their Twitter account, trace it back with their LinkedIn to find out what company they just got fired from, and search around and call the company and figure out what just happened. And those are the cases where it takes a little bit of work, but if you can find out what's happening in real time, you can actually make a lot of difference in telling a compelling story about how this does influence the economy. There's a reasonable case to be made that a lot of this stuff doesn't actually affect the economy. We've gotten to the point that people are so accustomed to the battles of Washington that they know it's going to get resolved at the last minute. They don't really worry about it, and they just move on after that. That's a sad state of affairs, but if that's actually happening, that's still a story that's worth telling on that side too.
And I would just like to make a plug for the very specific stories that indicate how the budget is affecting regions, industries. You know, if you can talk to city officials and say, well, we didn't get bike lanes because we lost federal funding. We're not going to build this new bridge. We're not going to hire 16 new teachers, so class sizes will get bigger. The local university, well, we didn't get a federal grant, and in fact, if you go to NIH, you find out they gave out, I'm making up a number, 26% less federal grant money last year. So that affected us because we thought we'd be able to do this research, and now we can't. You know, if you're able to look at specific sectors and tell people, here's what didn't happen. Didn't get built, didn't get opened, didn't get started, didn't get finished because of something that's happening in the budget. I think those are stories that
Doctors
people-
and Medicare payments right now with the compression of Medicare payments. If you haven't done a story on unemployment benefits and the expiration of extended benefits, then that's a fairly easy story to do. And if you want the academic debate on either side of that, I'd be happy to point you in the direction. And for anyone who has questions about how to get at some of this data, my email address is on here. Please do email me or just ping me and I'll call you to walk you through some of this stuff. I'm happy to do it.
That's a very nice offer. Thank you. Thank you, Sudeep and Paul. You guys were terrific.
Good. Thanks.
And I really, really appreciate